So building a home in 2025 feels out of reach for most people. Prices are high, materials are expensive, and lenders are stricter than ever. But the truth is, you can actually build your dream home if you understand how construction loans actually work. Because most buyers jump in without a plan, they hire a builder, and later find out that the bank won't finance it, or worse, they lose their loan halfway through the build. So by the end of this video, you'll know exactly how construction loans really work, what lenders expect, and the key mistakes that can stop your dream home before it even starts. So a construction loan is a short-term loan that's used to finance the building of a new home from the ground up. You kind of think of it like a work-in-progress loan because you're not borrowing money to buy something that already exists. You're borrowing money to create something from scratch. And unlike a traditional mortgage where the lender gives you one lump sum at closing, construction loans release money in stages called draws. And as different parts of your home are completed, like foundation, framing, and roofing, the loan usually covers just your land, labor, materials, permits, building costs, but it won't cover things like architectural designs or interior furnishing. Those are out-of-pocket expenses. So if your total build costs $500,000, you won't get all of that $500,000 up front. The bank will release $75,000 for your foundation or another $100,000 when the framing is done, and so on until the home is actually complete. Now, most buyers think that construction loans work like regular mortgage. Like, I get approved, the banks give me money, and I just start making payments. But that's not how it works. You actually make payments on the money that's actually being drawn, and that confusion alone can throw off your entire budget. So let's say you haven't started construction yet, you owe nothing until that first draw is used, but once the builder starts pouring in concrete, then your payments begin. So because you're only paying interest on what's drawn, you can then time your stages smartly. For example, if you know your builder can't start for 60 days, then you can delay your first draw. That way you don't have to pay any interest before the construction even begins. And before you even ever start applying for construction loans, there's something that determines whether your project will even qualify, and skipping this next step could cost you months of delays. So before you start sketching your floor plans or picking countertops, you want to get pre-approved for your construction loan up front, because this tells you what your budget is, what the bank will actually lend you, and sets the financial foundation for your entire build. So once you have that number, then you can confidently start choosing your builder and home plans that fits within your price. But here's the part where most people miss. Your builder actually has to get approved by the bank itself, and the bank will verify their license, their insurance, and their experience before they'll fund your project. So let's say you find a local builder who did your friend's home. If they're not registered or don't carry proper insurance, your bank can reject your entire loan, even if you love your work themselves. And a huge mistake, I see people spending months designing a $700,000 dream home only to find out that they're really qualified for only $500,000. Or they hire a builder first only to learn that that builder isn't bank approved and it has to be replaced, which sets their project back by months. So what you'll want to make sure is that number one, you get pre-approved first so that you know your max budget. Then you want to ask your lender for the builder approval checklist before hiring anyone. Then you'll design your home after you know your financing and your builder are approved. This order saves time, avoids redesigns, costs, and ensures your lender is ready to fund your project on day one. Now, before we go into the next step, if you're planning to buy a house in 2025, make sure you hit that subscribe button so you get notified every time I put a video out. So when you buy an existing home, the property itself acts as collateral, so the bank could sell it if something goes wrong. But with a construction loan, there's no finished house yet, so the banks take on more risk. And because of that, the qualifications are stricter. So you'll need a strong credit score, steady income, finalized blueprints, detailed budget, and a build timeline. So if your plan says a 3-bed, 2-bath, but you don't include like square footage, materials, or contractor bids, then the lender can't approve it, and they'll need exact numbers to calculate the risk. And a lot of times people often apply too early because they've just finalized plan or signed a builder contract. An incomplete file tells the lender that you're not ready, and you'll either end up delaying or they can deny the loan. So what you want to make sure is that you have more detail that you give up front, the smoother your approval will be. So have your builder create a cost breakdown, include materials, give you an outline of your timeline, and this shows that you're prepared and reduces a lot of underwriting questions, which can save you weeks of headaches and going back and forth. But even if you're approved, that doesn't mean the money's sitting in your account, and misunderstanding that how the funds are released can stall your build before you even start pouring the foundation. So construction loans are paid out in phases called draws, and each draw corresponds with a major part of the construction, like foundation, framing, drywall, and finishing work. And the bank actually sends an inspector before each draw to confirm that the stage is complete before releasing the next set of funds. So during this time, you only pay interest on the amount that you've drawn, not on the entire loan. So if your total loan is $500,000, but only $100,000 has been drawn from the foundation or framing, then your monthly payment is based on that $100,000 and not the full $500K. And borrowers forget that once they start drawing money, their monthly payments begin, even if the build pauses. So if the weather delays progress, then interest still occurs. So you want to make sure that you plan your draw schedule with your builder before starting, because when milestones are spaced efficiently, you'll reduce delays, save interest, and keep your project moving forward. But even with a smooth draw process, choosing the wrong type of construction loan can cost you $1,000 in extra fees. So there's really two main types of construction loans. You have number one, the one-time construction loans that combines your land purchase and the build into one single loan that automatically then turns into a mortgage once your build is complete. And then two, you have a construction to perm loan where you already own the land and you're just needing a loan to build on it. Now, a lot of times, many people think that they must go and finance the land separately, and then they end up needing a huge down payment, typically between 30 to 40% for the land financing, and they'll be paying closing costs 2 times. So with this one-time construction loan, that does not need to happen. You can get with a lot lower down payment. But even with the right loan type, your payments can still spiral if your interest rate changes mid-build. And most borrowers never seen it coming. So let's go over the interest rate. So construction loan rates are usually about 1% higher than standard mortgage rates, and they can be fixed or variable. So if the regular mortgage rates are around a 6.5, then expect your construction loan to land closer to 7.5, depending on your credit and your project type. Now, borrowers take variable rates, assuming that they're going to drop later, but if rates rise during your build, then your monthly payment can go up as well. So ask about rate lock options. Some lenders let you lock before consultation or when it's going to convert to regular financing, because that small move can save you thousands in 2025 if rates rise again or if they drop. So to qualify, most lenders require a credit score of at least a 700, a low debt to income ratio, and a down payment of about 5%. Now, if you already own your land, then that equity can often be counted towards your down payment. So let's say if your land is worth $100K and your total build is $500K, that $100K in land equity might serve as your 20% down payment, meaning that you don't owe extra cash up front. Now, a big mistake a lot of people make is people over design. They assume because they have the savings, the bank will lend whatever they need, but construction loans are based on income and affordability, not what's in your account. Now, and here's how you could use this to your advantage. So you want to keep your build realistic and stay within your income limits that your lender sets. And you want to leverage your land as equity and save your cash for different upgrades or contingencies. So before approving your loan, the lender is going to order an appraisal based on the blueprints and specs, and it estimates what your home will be worth once it's finished. So if you're building a 3,000 square foot home in a neighborhood of more like 1,800 square foot homes, the appraiser might value it lower than you expect, which can reduce your final loan amount. So you want to make sure that you don't submit vague or incomplete plans, because if the appraiser can't clearly see the materials, finishes, or layout, they'll estimate low, and that can ruin your approval. So work with your builder and your lender to make sure your plans are complete, detailed, and fit your area's market. It's better to build slightly under the neighborhood's average than to overbuild and lose funding. Now, once your appraisal is done, your build clock starts, and any delay now can mean higher interest rate, higher costs, and more stress. So building a home is exciting, but financing comes first. So the right loan, lender, and builder sets the stage for your project's success. And waiting until after you picked your plans or land to figure out financing, that's how people end up with stalled projects or unfinished homes. So make sure that you get pre-approved early so you know all of your numbers up front, help vet your builder, and make sure you're ready to break ground with confidence. And if you're planning to buy a house in 2025 and want to know exactly how much buying power you have using this program, click on the link in the description, schedule a call, and I'll be in touch.